Something unusual is happening in the global silver market, and most people are only seeing the surface. Prices on Western exchanges suggest calm, stability, even boredom. But underneath, a very different story is unfolding. One that starts in China, spreads through global supply chains, and ends with a widening gap between what silver is priced at on paper and what it costs to buy in the real world. China has quietly begun restricting silver exports, not with loud announcements, not with dramatic press conferences, but through tighter controls, permits, and prioritization of domestic demand. It is a familiar playbook. We've seen it before with rare earth elements, with gallium, with germanium. Materials first flow freely, then slowly tighten, and eventually become strategic leverage. Silver is now entering that phase. China is not just another participant in the silver market. It is one of the world's largest refiners, processors, and consumers of silver. Silver flows through Chinese factories into solar panels, semiconductors, electronics, batteries, and advanced manufacturing. When China decides that silver should stay home, the impact does not remain local. It ripples outward. Officially, China is often described as a net importer of silver, and that is true on paper. But what matters is not just net flow. What matters is control. China imports raw and semi-processed silver, refines it domestically, and increasingly channels refined metal into strategic industries. What leaves the country is now being watched more closely. As export controls tighten, less Chinese silver reaches international markets. That reduction may look small at first, but silver is a thin market. A few percentage points of supply disruption can change everything. What makes this moment especially important is that silver is no longer behaving like a traditional precious metal. For decades, silver sat in a strange middle ground. It was treated as an investment asset during crises and as an industrial input during growth cycles. But today, those two roles are colliding. Investment demand is rising at the same time industrial demand is accelerating. That overlap is rare, and historically, it has never lasted long without dramatic repricing. China's decision to restrict silver exports must be understood in that context. This is not about short-term price management. This is about securing long-term supply for strategic industries. Solar power alone consumes massive amounts of silver, and China dominates global solar manufacturing. Every new panel requires silver paste. Every expansion of renewable infrastructure tightens demand further. And unlike oil or gas, silver has no easy substitute at scale. At the same time, China is racing ahead in advanced batteries, electric vehicles, semiconductors, and defense technologies. All of them rely on silver's unique conductivity and reliability. When a country begins to treat silver as an industrial lifeline rather than a commodity, exports naturally become a secondary concern. This is where global price distortions begin to deepen. In theory, commodity markets should equalize prices across regions. If silver is cheaper in one market, traders buy there and sell where prices are higher. That arbitrage keeps everything aligned. But arbitrage requires physical movement of metal. When exports tighten, that mechanism breaks down. That is exactly what is happening now. Silver priced on Western futures exchanges reflects leverage, liquidity, and speculation. Silver priced in Asia reflects availability, delivery time, and physical scarcity. These are two different pricing systems describing two different realities. In India, for example, silver demand has surged, not just among investors, but among manufacturers. India is rapidly expanding its electronics and renewable energy sectors. At the same time, households increasingly view silver as an affordable store of value in an uncertain global economy. When inflation erodes purchasing power and currencies fluctuate, physical metals regain cultural and financial relevance. As demand rises and supply tightens, premiums expand. This is why the same ounce of silver can appear cheap on a screen in New York, while being expensive and difficult to source in Mumbai or Shanghai. The price difference is not an anomaly. It is a warning. Western markets, particularly futures-based ones, have grown accustomed to pricing silver as if supply is endless. Contracts roll over, positions are netted, delivery is deferred. Most participants never intend to take metal. That system works only as long as confidence remains intact. But confidence is fragile. Once enough buyers demand physical delivery, paper markets face stress. Inventories matter less than perception. And perception changes quickly when delivery delays grow longer, premiums spike, and alternative markets offer better pricing for actual metal. China's export restrictions amplify that pressure. By keeping silver inside its borders, China effectively removes a buffer from the global system. Less metal is available to absorb shocks. Less metal is available to satisfy unexpected demand. And less metal is available to smooth price volatility. This creates a one-way imbalance. On one side, you have futures markets that can create virtually unlimited paper supply. On the other, you have physical markets that cannot conjure silver out of thin air. When those two worlds diverge too far, one of them must adjust. Historically, it is never the physical market that blinks first. Another layer to this story is strategic trust. Countries are becoming more cautious about relying on global supply chains for critical materials. The pandemic exposed vulnerabilities. Geopolitical tensions intensified them. Sanctions, trade wars, and export controls are no longer exceptions. They are becoming tools of policy. Silver now sits uncomfortably close to that geopolitical fault line. China understands that controlling refined materials offers leverage far beyond raw resource ownership. Restricting exports does not require confrontation. It does not provoke immediate retaliation, but it quietly reshapes market behavior over time. Buyers adapt, stockpiles grow, long-term contracts replace spot purchases, and slowly the open market shrinks. As that happens, price discovery shifts. We are already seeing signs that Asian exchanges are gaining influence in precious metals pricing, especially where physical settlement dominates. When enough volume migrates toward delivery-focused markets, benchmarks change. Western prices eventually follow, but often only after sharp adjustments. This is why silver's current calm is misleading. Low volatility does not mean low risk. It often means pressure is being stored rather than released. And pressure stored in physical supply chains has a habit of surfacing suddenly. Mining supply offers little relief. Silver production is largely a byproduct of mining other metals like copper, lead, and zinc. That means supply cannot easily respond to higher prices. Even if silver prices rise, miners cannot quickly increase output without changes in other markets. That rigidity makes silver uniquely sensitive to demand shocks. When China restricts exports, India absorbs more supply, industrial usage grows, and investors increase physical holdings. The system tightens from every angle at once. Paper markets can delay recognition, but they cannot prevent it indefinitely. At some point, the gap between paper prices and physical reality becomes too wide to ignore. And when that happens, repricing is rarely smooth. This is why watching export policies matters more than watching daily price ticks. Export controls tell you how governments view the future. They reveal which materials are considered strategic, scarce, and worth protecting. China would not restrict silver if it believed supply was abundant and easily replaceable. It would not prioritize domestic allocation if alternatives existed at scale. These decisions are signals, not accidents. The widening price differences across the world are simply the market translating those signals into action. What looks like a regional policy today may end up reshaping global silver pricing tomorrow. And by the time that shift is obvious to everyone, the quiet phase will already be over. China is not just another participant in the silver market. It is one of the world's largest refiners, processors, and consumers of silver. Silver flows through Chinese factories into solar panels, semiconductors, electronics, batteries, and advanced manufacturing. When China decides that silver should stay home, the impact does not remain local. It ripples outward. Officially, China is often described as a net importer of silver, and that is true on paper. But what matters is not just net flow. What matters is control. China imports raw and semi-processed silver, refines it domestically, and increasingly channels refined metal into strategic industries. What leaves the country is now being watched more closely. As export controls tighten, less Chinese silver reaches international markets. That reduction may look small at first, but silver is a thin market. A few percentage points of supply disruption can change everything. Now here's where the story becomes uncomfortable. While physical silver is being absorbed by Asia, prices in Western markets are still largely set by futures exchanges. Most notably, the COMEX. On these exchanges, silver is traded mostly as contracts, not metal, promises, not bars. Vast volumes change hands every day, but only a tiny fraction ever result in physical delivery. This creates a structural imbalance. In China, silver trades on the Shanghai Exchange, where physical delivery is central. In India, retail demand for silver is exploding, driven by investment demand, industrial growth, and cultural preference for tangible assets. In both markets, buyers want metal in hand. As a result, silver in Asia is starting to trade at a premium. The same ounce of silver can have two very different prices depending on where you are. In Western markets, silver appears plentiful, liquid, and cheap. In Eastern markets, it is tighter, harder to source, and increasingly expensive. This price divergence is not accidental. It is a signal. When physical demand overwhelms paper supply, markets fragment, and that fragmentation is already visible. Dealers in Asia report longer delivery times. Premiums over spot prices are rising. Industrial buyers are locking in supply early, sometimes months in advance. Meanwhile, Western exchanges continue to price silver as if nothing has changed. But something has changed. China's restriction on silver exports means less metal available to balance global demand. India's silver consumption is accelerating, driven by solar installations, electronics manufacturing, and a growing investor base seeking protection against inflation and currency risk. At the same time, mining supply growth remains limited. New silver mines are rare, capital-intensive, and slow to bring online. This creates a squeeze that paper markets struggle to reflect. And then there is geopolitics. Silver is not just a precious metal, it is a strategic material. Modern economies cannot function without it. Solar energy, electric vehicles, advanced electronics, defense systems all require silver. When global supply chains are under strain, countries prioritize access. China understands this. It is positioning itself not just as a consumer, but as a gatekeeper. By restricting exports, China ensures its own industries are insulated from global shortages. But it also forces other countries to compete for a shrinking pool of available silver. That competition drives up real prices, even if futures markets lag behind. This is how price suppression narratives are born. Not because of conspiracy, but because of structural mismatch. When paper markets dominate price discovery and physical markets dominate demand, divergence is inevitable. You can already see the cracks. COMEX inventories fluctuate, but confidence matters more than numbers. If enough participants begin to doubt that paper contracts can always be converted into metal, behavior changes. People ask for delivery. They hedge differently. They move capital into physical markets. That is when price gaps widen rapidly. China's actions accelerate this process. Less exportable silver means less metal available to arbitrage price differences between East and West. That arbitrage has kept global prices aligned for decades. As it weakens, regional prices begin to decouple. We are watching the early stages of that decoupling now. This is not a sudden event. It is a slow pressure build. But slow pressure builds are often the most powerful. They don't announce themselves. They reveal themselves after the fact. And history is clear on one point. When strategic commodities become scarce, price discovery moves to where the physical metal flows, not where the most contracts trade. Silver is quietly shifting from a financial asset back toward a strategic resource. For investors, for industries, and for governments, this matters a lot. Because once supply chains reprice risk, they rarely go back. And when physical premiums become normalized, paper prices eventually follow, sometimes violently. China's restriction on silver exports is not just a trade policy. It is a signal that silver is no longer treated as abundant, that it is being stockpiled, prioritized, and protected. And the growing price differences across the world are the market's way of telling us that something fundamental is changing. The question is not whether silver will reflect this shift. The question is where that reflection will appear first, on a futures screen or in the real economy where silver actually moves.